You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Every single time you have financed something in your life, a car, a home, a business, a college education, you have paid a bank for the privilege of using money. And when you paid that loan off, you celebrated. But here's the question. Where did that interest go? It went to the bank, of course. It made the bank wealthier while you started over. You maybe saved up for something, saved, and finally acquired the amount needed, withdrew the money, and used cash to buy what you needed or wanted, causing your account to be drained and you to start back at $0. Now, this is an extreme example, as you may not totally need to wipe out your savings when you need those funds, but you get the idea. What if that interest had stayed with you? What if you were the bank? Welcome back to Infinite Banking Mastery. I'm Valerie LaRocque, and today we're going to talk about exactly that. Let's start off talking about how banks work. Banks borrow money cheaply from depositors at low interest, and then they lend it out at a much higher rate. The gap between those two rates, the spread, is the engine of their profitability. Your savings account earns, let's say, 0.5%. The bank loans that money out at, say, 5, 7, 8, 10% interest as an example, and they keep the difference. You funded the engine, but you don't get to share in the profit. Banks also use a concept called fractional reserve banking. They are allowed to lend out multiples of what they actually hold on deposit. I'd mentioned this before in previous podcasts. They are basically creating money from thin air. And then there's mutual life insurance companies. They collect premiums, they invest those funds conservatively, and pay out claims and dividends. Of course, remember that you are the first borrower in line to borrow against your policy. You have first right to borrow the money. Now, one critical difference between a bank and a mutual life insurance company is that you participate in the profit side, not just the depositor side. You are not just the customer, you become a shareholder in your own private financial system. Again, my favorite quote from Nelson Nash, "We finance everything we buy. We either pay interest to someone else or we give up interest we could have earned. The only question is, who's capturing the interest?" The infinite banking concept is designed to capture the interest earnings that you would have lost. I want to paint this as simplistically as I possibly can, the mechanics of becoming your own banker. First off, it's your actions that make you a solid banker, not the whole life policy itself. The policy is just the best place that we think to house your funds, the most stable, and while you are using the policy to house your dollars, it has a lot of other benefits. A well-built whole life insurance policy structured in a way to build up cash value more quickly without causing the policy growth to become taxable is our recommended foundation for your private banking system. However, you are the key. Your actions are the key. Treating yourself like an honest banker, and for those of you who have read Nelson Nash's book, make sure you don't steal the peace. Paying your policy back during the years prior to retirement is the key to your success and growing your system. So now your premium payments build cash value. That cash value grows every year, guaranteed, tax invisible, not correlated to markets, and is a great reserve account for your private bank. The life insurance company declares dividends annually. And just a side note and reminder that the dividends are not guaranteed by any company and that what you see on an illustration is just a projection of what they expect to pay. Although the track record of those we work with is incredibly strong. But anyway, these dividends are added to your cash value, compounding your account's cash value continuously. Your account is only always going up. Due to the premiums you are adding in, the guaranteed crediting rate, the dividends, and the guaranteed rate that will be building on the dividends that are being added to your account each year. Because once those dividends have been earned and are in your account, they become a part of your cash value that is going up by the guaranteed rate. Now, step 2 in this process is policy loans. When you need capital to buy a car, fund a business expansion, cover an emergency, invest in real estate, or pay off debt to outside banks, you do not go to a bank if you don't have to. You take a policy loan against your cash value. The insurance company lends you their money using your cash value and death benefit as collateral. Your cash value continues to earn dividends and your account continues to grow as if you never touched it. This is called uninterrupted compounding, and it is a big part of what makes the system so awesome and powerful. Now, the loan carries a fixed interest rate or variable, depending on the company, as some policy contracts come with variable rates. My primary company allows you to choose whether you want a fixed or variable rate. But when you go to the company for a loan, there is no application, no credit check, no approval timeline, no bank calling the loan due, and you get to set the repayment schedule. Which brings us to step 3, repaying yourself. When you repay the loan with interest, you are building your banking system. Now, the company will keep the interest for whatever rate they are charging, which is a good thing as you are now a partial owner of the company. I would think you would want your company to be profitable, and you are receiving some of that profit in the form of a dividend. You are paying back to a system you have ownership in, rather than to a commercial lender. Every repayment that you make to your policy rebuilds your reserve. And if you are paying yourself back at a higher rate than the insurance company is charging, which is what Nelson Nash would suggest to do, you are building your banking system every time you redirect those excess dollars into premium whenever possible. Think about the vehicles you have financed in your lifetime. Every car payment you ever made sent interest to a lender. With your own private banking system, you can finance your next vehicle through the policy, pay yourself back at that same rate, and your full cash value, including the amount you borrowed against, continues to earn dividends and interest the entire time. Let's look at some examples. First example will be buying cars. Instead of financing through a dealership at 6 to 8%, you take a policy loan. Your cash value continues earning dividends on the full balance while the loan is outstanding. You repay yourself over the same timeline you would have paid the bank, but the interest cycles back into your system instead of disappearing into a lender's ledger. So this for every car you ever buy for the rest of your life, and the compounding effect becomes significant. Example 2 is for a business owner. A business owner needs capital for equipment, inventory, or a new hire. Your traditional options are to get a bank loan with qualification requirements or pulling from savings and reserves and losing the compounding on those dollars. With a policy loan, the capital is available immediately. The cash value keeps compounding and repayment is on your terms, not the bank's. Many business owners use their policy as part of the working capital reserve that used to sit idle in a low-interest business checking account. Example 3. For the real estate investor. If you're a real estate investor, you might use policy loans for down payments, renovation costs, or bridge financing while waiting on other assets to sell. The policy's liquidity and flexible repayment options make it one of the most strategic tools you could have in your arsenal. Unlike a HELOC, it cannot be frozen, reduced, or called in by a lender. Now, who is the infinite banking concept for? It's for those ready to take ownership of their financial lives and take action. You have to fund the policy consistently, and when you take loans, you should repay them with discipline. The policy rewards those who treat it like a system, not just a set it and forget it type of account. Of course, it will still grow, it will still do all the things that you would expect it to do, even if you're not banking with it, if you just leave it, let it sit and just forget about it. But it's going to be a lot more powerful, and it's going to be what you expect if you are taking the actions to be a banker, to run your money through it, to flow your money, to run as much money as you can through the policies, and then turn around and use those dollars for whatever else you might need in your life or desire to invest in or pay off debts. If you're using it and flowing your money through it, you're going to end up growing your system as opposed to setting it and forgetting it. It'll still grow. It'll still be there. It'll still be accessible. It just won't be as amazing as you might have initially envisioned. The infinite banking concept is for you if you're interested in recapturing dollars currently going to banks, or if you're interested in redirecting dollars currently going to tax-deferred accounts. Or maybe you've maxed out those tax-deferred accounts and you need someplace else that you need to build money or save wealth or build capital. So long as you're insurable or someone whom you have an insurable interest in is insurable, then this could be an option for you. If you have a need to finance large purchases regularly, such as vehicles, equipment, real estate, inventory, education, and want to stop sending that interest to lenders and instead redirect those dollars to building your financial future, then this concept could be for you. If you're interested in having certainty in at least one part of your financial life and are drawn to guaranteed growth, guaranteed access, tax invisibility, and no market exposure, this could be for you. This concept is for you if you're thinking generationally. You want to build a system your children and grandchildren can inherit and continue. Sometimes people ask if their children can continue a policy on their life, the parent, once they're gone, and that's not the case because the life policy would pay the death claim if you were to pass away. But if you've taught your children or allowed me or some other practitioner to teach your children, then they will know what to do or who to go to when you graduate from this earth and that death benefit pays. One critical note on policy design, keep in mind that not all whole life policies are designed optimally for the infinite banking concept, although most whole life, at least all the contracts that I'm aware of, do allow you to borrow against them. So if you have an existing whole life policy, you should take it to the advisor or agent helping you with IBC, and they should be able to give you some direction and helpful feedback. However, replacing that policy is probably not necessary as whole life does get better with age. You just have to take a look at it and see what the options are. But I usually don't replace existing whole life. I do replace index universal life policies all the time. Or if you have a term policy and you're ready to start building whole life, maybe you replace some of the term. Just depends on your situation. But if you're looking to get started with this strategy, you should definitely work with an infinite banking practitioner who specializes in this, whether it be me or someone else. The right policy designed correctly is a different animal than what most people picture when they hear life insurance. This is not your average grandfather's policy. Unless he bought it in the last 20 or so years from someone knowledgeable on IBC. This is more like a financial system that happens to have a death benefit attached. For your entire financial life, you have been the customer. You've deposited money into institutions that lent it back to you at a profit. You've financed purchases through lenders who collected interest you will never see again. You saved inside accounts that the government taxes, limits, and regulates on their schedule. Every system you have participated in was designed by someone else and for someone else's benefit. Infinite banking is the decision to change all of that. It is the decision to build your own system, to capture the interest, to control the timeline, to be the bank. That decision does not require you to be wealthy to start. It just requires you to start. And if you're ready to do so and would like to work with me, feel free to reach out. You can reach me at Valerie@Alpha Omega Wealth. Again, I'm Valerie LaRocque. This is Infinite Banking Mastery. Go be the bank.
This is thepodcastfactory.com.